Warren Buffett has long said that his main job as CEO of Berkshire Hathaway is to allocate capital in order to generate the best returns in the long term for shareholders. And in a recent podcast with William Green, super investor Tom Russo actually recounted a conversation that he had with the CEO of a Berkshire Hathaway subsidiary, namely TTI. Now, when Tom Russo asked that CEO about the main benefit of becoming a Berkshire Hathaway subsidiary, he basically said that we don't have to worry about capital anymore. If we have too much capital and we've got cash piling up, we can send it to Omaha. And if we've got big projects that require a lot of capital but will earn really good returns in the long term, we can call Omaha and request that capital in order to go ahead with that project. And of course, not having to worry about capital is not a typical CEO experience. It's not a luxury that everyone has, and it's certainly not something that individuals have. We all have to manage our own personal finances and allocate cash between investing or debt repayment or saving cash for some future purchase. And for the first time in quite a few years, I personally have actually had a pretty significant change in my personal capital allocation recently. We've just gone ahead and purchased our first home. For the first time, we really have a pretty significant amount of debt, and that's got me thinking about my own personal capital allocation. Now, a great example of mistakes that can happen with capital allocation when you don't have this situation of being a Berkshire Hathaway subsidiary, just as an example, is what happened with Altria. Now, if we jump across to Simply Wall Street and have a look at the balance sheet history for Altria, you can see that back in 2018, they had a very healthy equity position. And of course, having a healthy equity position is much better for Altria than drowning in debt, but it does come with this sort of institutional imperative. You see the cash building up, you see the equity getting healthier and healthier, and particularly when you have CEOs that have perhaps misaligned incentive packages, it can cause those managers to make really bad capital management errors. They can make dumb acquisitions, and again, this is something that Tom Russo recently shared in his conversation with William Green.
So in one fell swoop, they massively leveraged up their balance sheet.
One of the strengths, right? Which is
the Jewel. Jewel cost them $34.5 billion from the time they bought it to the time they just recently wrote off some of the final bits.
In the case of Altria, they ended up acquiring a business called Jewel back in 2018. They stacked the company's balance sheet with debt. The Jewel business itself actually really performed quite poorly, and they're actually now in a position where they have negative shareholders' equity. Now, Simply Wall Street helps provide investors context around all different aspects of a business, including where earnings for Altria might be heading in the next couple of years. So if you're interested in checking out the Altria company report, I will leave that link down in the description below. Simply Wall Street is free to use, and you can research up to 5 stocks per month, but the first 100 people to use that link can explore the platform limit-free for 14 days and can also get a 40% discount on the unlimited plan. Now, the combination of Buffett describing his role as a capital allocator, listening to this recent podcast with Tom Russo, and that combined with my recent change in personal finance with having a mortgage, basically, all of this has really got me thinking about a couple of key things when it comes to capital allocation in my personal life. Firstly, I want to talk a little bit in this video about risk. We will look at some Buffett and Munger clips around what they had to say about risk, and then I'll kind of talk a bit about how I'm thinking about it. And secondly, I want to talk a little bit about opportunity costs, because the equation has really changed for me recently. I now have the option to save cash, I can pay debt, I can buy into stocks that I already own and buy more of them, or I can potentially buy into new stocks. Firstly, let's play a short clip here from Warren Buffett talking about the difference between volatility and risk.
And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. Actually, take it with farmland. Here in 1980 or in the early 1980s, farms that sold for $2,000 an acre went to $600 an acre. I bought one of them, and the beta of farms shot way up. And according to standard economic theory, market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier.
So if you've been following Buffett for some period of time, you may have heard him say something like that before. Basically, the academic definition of risk, or beta, which basically just describes the volatility of a stock relative to an index like the S&P 500, that's not really a true measure of risk. What Buffett really defines risk as is the potential for a permanent loss of capital. In other words, if he puts a big chunk of money into a particular stock, what's the probability that he's not going to be able to pull that same amount of money back out again? And that's not to say that Buffett has never been down on a stock, even when he has made a correct assessment of a business and the investment has worked out well on the long term, the price can do anything in the short term. Buffett and Munger have talked many times about, for you to be able to generate good results in the stock market, you have to be able to stomach a lot of volatility, including not only the ups but also the downs. So that's not really what we're talking about here. That is in fact beta and kind of the academic definition of volatility, that stocks just swing around a lot. What Buffett's really paying attention to here is the underlying performance of the actual businesses that he's buying into. What is the chance that if he pays a reasonable valuation for this business, that the business results are going to go south, and that's going to cause a permanent loss. Maybe the company goes bankrupt, and that of course causes a permanent loss. Those are the types of questions that Buffett is really trying to answer here. So with that in mind, I want to play two more clips here, one from Warren Buffett and one from Charlie Munger. Firstly, Warren Buffett kind of talking about the cost of capital, and how, again, cost of capital is another one of these very academic equations when it comes to investment and capital allocation. And Buffett basically thinks that that's kind of a bogus concept. He's never seen an intelligent cost of capital discussion, and Munger has basically the same view, maybe even a slightly more aggressive view on that particular topic. But Buffett does recognize that money costs money, and just like the TTI example at the start of the video, where this Berkshire CEO no longer had to worry about capital. They could send the excess cash to Omaha, or they could request cash from Omaha for, capital projects with good returns and so on. Buffett recognizes that, money does cost money, and there is a real opportunity cost to Berkshire Hathaway subsidiaries having more capital than they potentially need in their business. And straight after that, let's have a look at a clip of Charlie Munger talking about how everything really comes down to opportunity cost.
And we want our managers to understand just how highly we do value capital, and we feel there's nothing that creates a better understanding than to charge them for it. We have arrangements depending on on those variables, and perhaps some others, and perhaps just how we felt the day we drew it up, that range between 14% and 20% in terms of capital advanced. And
we will do the most intelligent thing we can with the capital we have. And so we measure alternatives against each other, and we measure alternatives against dividends, and we measure alternatives against repurchase of shares. But I have never seen a cost of capital calculation that made sense to me. How about you, Charlie?
If you take the most powerful freshman text in economics, which is by Mankiw of Harvard, and he says on practically the first page that intelligent people make their decisions based on opportunity cost. In other words, it's your alternatives that are competing for the use of your time or money that matter in judging whether you take action or not. And of course, those vary greatly from time to time and from company to company. And we tend to make all of our financial decisions based on our opportunity cost, just as like they teach in freshman economics.
Yeah,
and the rest of the world has gone off on some crazy kick where they can create a standard formula, and that's cost. They even get a cost of equity capital for some business that's old and filthy rich. It's a perfectly amazing mental malfunction.
At the end of the day here, everything really comes down to opportunity cost. So let me spend a few minutes talking through basically how my situation's changed a little bit recently when it comes to opportunity cost. More specifically, we've bought a house, we've obviously put down a deposit, but we've taken on some debt as well, and that has kind of changed the equation for me a little bit. So let me take you back to a few months ago and really what the pictures look like over the past few years in terms of my own personal capital allocation. Now, I have a day job, money comes in from that day job. I also have some additional sources of income through this YouTube channel, so thank you very much for watching these videos. It does not go unappreciated. And, basically money would come in the door. Of course, I would have bills, etc. to pay, but I was basically taking the very old school Robert Kiyosaki type approach of pay yourself first. So anytime money comes in the door, like clockwork, a reasonably substantial portion of that was set aside and would basically go into cash savings accounts. Of course, I'm always looking at stocks and potential new investment opportunities, and basically what would happen is anytime that I found something interesting, I would take some of that cash and allocate it to a new investment, a new stock, or maybe a stock I already own. I still found interesting and I kept adding to it. And it was kind of like a very, very miniature Berkshire Hathaway-esque type approach where I really have no debt. The cash would steadily pile up. When I found something interesting, that cash would drop down pretty rapidly because I put it into a new stock. And that cycle would kind of just repeat over time. So when I looked at my universe of opportunities, it was a very simple equation. I could basically leave cash sitting in a savings account, earning basically nothing, definitely nothing after inflation, or I could allocate some capital to stocks, which I thought would earn a reasonable return with sufficient downside protection. But the equation has now changed somewhat since taking on a mortgage, and the opportunity cost set is a little different, and I thought it would be kind of interesting to talk about here on the channel. So I guess the initial sort of personal finance side looks pretty similar. I still have cash coming in the door from my job and from additional sources of income. I essentially funnel a lot of that off towards fortnightly mortgage payments, and I basically have that debt structured in a couple of different ways. So the big chunk of it is just in a traditional 30-year mortgage. Unfortunately, in New Zealand, we don't have these 30-year fixed rate mortgages like US investors might be used to, but we do have that interest rate locked for a period of time, certainly not 30 years, but locked for a period of time, and that's debt that I intend to probably keep for a period of time just to get all the advantages of leverage. So there's regular kind of payments that go towards that every couple of weeks, but I have really no intention of paying that down more quickly than I really need to. Now, luckily for us, we are also in the position where our monthly incomes do generate more than the minimum requirement to pay our mortgage, which is hopefully a position that everyone's getting into when they take on a mortgage. But, we do have other cash accumulating over and above what's required to pay our mortgage each month. And that is really where this opportunity cost equation starts to come in, because this is really where, I, as a capital allocator of, our own personal funds, have to start to make a decision. I can either put more money towards repaying debt, and that's effectively giving us like a guaranteed return of just whatever our interest rate is, or we can start to funnel money towards stocks. And of course, even between people that have mortgages, the opportunity cost may be different. If you happen to lock in an interest rate in 2020 when rates were really low, that means that maybe there's a sort of a lower hurdle for you to get over to put money towards stocks, because maybe your mortgage is only at 3% interest or something, and you think you can earn substantially more than that in your stock investments. Or if you locked in your interest rate for a longer period of time and you did it more recently with higher interest rates, accounts, then that means that potentially that hurdle rate is slightly higher for you with paying down debt versus investing in businesses. And for me, the new hurdle rate certainly is higher than the 0% it used to be, when I was earning basically nothing in a savings account with cash. And of course, wrapped up in all of this is really a lot of personal preference, of course. Some people, particularly if you come from like a Dave Ramsey school of thought, would really put all of that surplus cash towards aggressively repaying debt and trying to get out of debt really fast. If you come from more of a Graham Stephan school of thought or a Jack Duffley, shout out to Jack, school of thought, maybe you want to stay more heavily indebted for a longer period of time and take advantage of some of the positives, that come with leverage. Of course, leverage is a double-edged sword, and you have to make sure that you don't get yourself into trouble by having too much debt and not being able to service it if something should go wrong in terms of your income and so on. But there are genuine advantages to having leverage, and it's going to be pretty personal where you probably fall on that spectrum of repaying debt aggressively versus keeping as much debt as possible, and maybe you land somewhere in the middle. But at the end of the day, the way that I'm now thinking about it is really opportunity cost. I need to stack up what type of return I think I can get from investing in a particular stock versus what return I know I can get immediately from repaying debt. So there you have just a few thoughts that have been going through my head recently when it comes to personal finance and allocating your own personal capital. It's an equation that will be different from person to person, and there are some general frameworks, though, from the likes of Buffett and Munger that they've put out over the years that we can follow. So if you enjoyed the video and made it to the end, thank you very much for watching. Please like and subscribe to the channel if you haven't already. But that's it from me for this one, and I'll see you in the next video. Cheers.